Now let's talk fixed income investments with Dr. Stephen Nash from Fig Securities in Sydney. Warm welcome to you. As always, the concern of the Reserve Bank right now when it comes to reduction in lending standards. What did you take from the Financial Stability Review report on that matter?
Well, look, basically the RBA is not saying that the banks have relaxed any standards at the moment, but they're concerned that given the low level of growth in credit and the reticence of consumers to borrow, that there'll be more competition, and that competition may lead to a drop in lending standards. So I think this is just anticipating that development possibly towards the end of the year. So I suppose the message is everything's fine right now, but going forward there could be problems.
Well, are they stating the obvious? Are they expecting the banks to make a move in this area? And if so, what can they do to bring that about?
I imagine that the supervising authority will be looking at the banks fairly closely going forward and ensuring that those standards aren't dropping. That's about all we can do at the moment. I think that the focus will be on those standards and monitoring what's going on there. I think the competition in this space is going to be very, very high at the moment because there is really no growth in credit right now, so the banks have to compete more aggressively.
That said, they are, as a result, flushed with cash. We can talk alternate funding sources, something that, again, was on the watch list from this review. But is there necessarily an appetite, given that banks have got so many consumers choosing to leave their money right where it is, inside those accounts?
Well, what's been happening is, yes, the deposit levels have been increasing, and banks have been able to reduce short-term funding and switch some of that to long-term funding. And it's good to see some longer issues, but generally in the Australian market it's difficult for the banks to issue longer term debt out towards the 7-10 year level. They've gone out to the 5-year area right now, but there should be some support for the banks and other issuers to get out there and issue longer debt, but that would require, I think, a suite of measures which really aren't being developed right now.
Well, timeline on that one, what are you hearing? Because we talk about the need for reform. We talk till we're blue in the face, but not much seems to happen.
Look, I think that there has been some reform with regard to bond issuance documentation of late. There has been some movements by the Treasury last time in terms of the budget, in terms of taxation of bonds. There will be more, I think, in the budget coming up about the inequality of taxation between debt and equity, and that's got to be addressed. I think that's a major problem right now. Also, I think there's also a problem with accessing fixed income for small investors. Looking at the SMSF sector, the allocation to fixed income is something of the order of 30 to 50 times less than equities. I mean, it's really radically low. It should be much higher than that. The reason I think that it's so low is that people can't get access to fixed income.
Well, if they could get access, taking it from the current 1%, what level would you be comfortable with to bring it more into line with cash, or what level?
I think there is a very high level of cash at the moment, in the order of over 25% in cash. Now, possibly at least 10% of that should be moved into bonds, I would have thought. The question for a lot of investors now is whether they put that cash back into the equity market, and I think there is a third way, and that's fixed income.
All right, there was a development as well this week on covered bonds. You're saying, though, this development does not go far enough to make things smooth sailing for banks. Why not?
Well, I think, look, it's going to help. I think the managers of the various banks have already mentioned that it's a positive development. It will definitely assist the banks, but the problem for the banks is their longer-term senior debt and the levels that trades at. And there's a lot of competition in the global banking sector right now. Spreads are tending to stabilise or move up a little bit. That's where the overall funding level of the banks will be set. So covered bonds, yeah, it's a good development, but it's not a solution to the funding problem, I don't think.
And as you say, it's really overseas investors who are going to be taking up that entitlement.
Well, it's a global product. It was really designed for I suppose mainly European investors. I think European investors will look at these bonds very favourably, and I think there will be a good uptake there, and it probably will help diversify the funding of the banks quite a bit. there is a question of whether or not the issuance of the covered bonds will increase spreads in other parts of the bank's funding. And I imagine that may occur, but it's only going to be a fairly small increase. I would have thought the position of the senior debt holders is still very secure.
All right, let's shift away from all of that. Let's go offshore because overnight action, we got some numbers coming out of the United States, jobless claims. Slice and dice and tell me what you end up with on those.
Well, with the 4-week moving average going towards 380,000, that's quite positive for US employment growth. We should get some good non-farm payrolls coming out in the next few months, and that's quite positive. The problem against that is the current state of the housing market, and we've had some fairly bad releases with regard to that over the week. So we've got the positives and the negatives.
Well, I mean, is that really a positive? Because put alongside it the state of continuing claims coming in at 3,721,000. Consensus was for 3,700,000.
Yeah. Like broadly, that we've been seeing a reduction in jobless claims, and I think that's what I'm trying to point out is that that broad improvement should be associated with a broad improvement with employment over the short term, and I think that's basically accepted within the community at this stage.
We still though we don't have the pass-through on consumer confidence. That is now sitting at a new 7-month low.
Yeah, well, I think these issues with the housing market are affecting consumer sentiment a lot. I mean, there's still an overhang in a lot of the states there, and there's also a big difference in the way the mortgage claims are being processed within the courts. Some states are very quick, others are very slow, and it's really affecting across the country which states are going to recover more quickly than others. There's an anticipation that California, for example, may come out of this faster than other states.
It sounds like the recovery in the Eurozone. Yeah. There will be some who stagger and, I guess, stutter their way towards growth, others who will be that much further ahead. Thank you so much.
Thank you.
Have a good weekend. Dr. Stephen Nash from Fig Security.